Hello there. Welcome back to Cost and Management Accounting N5. Still working on question papers. We want to look at a question paper of November 2020. This question paper that we have, and with that question paper, we want to look at question 5. We want to look at question 5, and that question 5 requires us to prepare the balance sheet. So this is our question 5. So we are going to look at 5.1. 5.1 specifically. That's where we are going to look at according to this video. So the question that we have reads the following appears in the books of Bargain Manufacturing for the year ended 30 November 2019. We are given a list of balances that we have there down, and then we have got the required part, which is saying prepare the statement of financial position. That is the balance sheet of Bargain Manufacturing as on 30 November 2019. So this is a balance sheet that we're going to prepare. Very simple it is because this statement of financial position has no adjustments in terms of whether you need to adjust for prepayments, accruals. We don't have such in this question. We are just picking the figures that are given in the list of balances and just putting the figures in the layout of the balance sheet. So if you come here on our answer section now, we are having that balance sheet of Bongani Manufacturing as on 30 November 2019. So we obviously the balance sheet, we're going to start with assets, and then we start with the non-current assets. So basically, what you need to understand on this balance sheet is that it obeys what is called the accounting equation. We have the accounting equation. Very important to know this accounting equation. It describes the balance sheet. So basically, the balance sheet obeys this law of the accounting equation. It says assets, these are total assets, equal to total liabilities plus equity. So this is what we have. So we are just going to prepare it as it is, whereby we have the first part. We are going to prepare the assets in terms of non-current assets and current assets, and then we get the total. This is going to give us the first balancing figure. Then it should be equal to the second part of the balance sheet, whereby we are going to list. We're going to start with equity. Then we also put our liabilities. Liabilities also are subdivided into current liabilities and non-current liabilities. So if we add these two, the total that you get here should be equal to the total for total assets. So that is the accounting equation, and it describes the layout that we have there of the balance sheet. Very important to know that we can start with the non-current assets and we go to our question to check which non-current assets are we given in the question. These are the balances that we have. So if you come here, we have our land and buildings. These are non-current assets. Remember, non-current assets are those assets that stay in the business for a period of more than a year. They are resources of the business that stay in the business for, on average, a period of more than a year. So we have land and buildings. We know that these are forever there. And then we have got equipment, also stays for more than a year. Vehicles are the same. So we've got these three. This describes the resources of the business that are going to stay in the business for more than a year. So what we are going to do is we are just going to the figures that we have there for land and buildings. We have got 1,750,000, 450,000, and 800,000. So we are going to add these three. We are going to say this one plus this one plus this one. Then we get our total. Then our total is the one that is going to represent our non-current assets. So we are just going to list property, plant and equipment, property, plant and equipment, and vehicles. Property, plant and equipment, and vehicles, and then we put the total that we are going to get there. So if you add these three, you see that the total that we are going to get there is 3 million. So 3 million is going to be what we are going to put there. Don't put them individually, as in you put land and building separately and then put equipment separately. You just add them together and then put them as one figure. So we come here now on the answer section now. We are just going to describe them as our property, plants, equipment, and vehicles. And then on the additional part, remember, with one for the figures of the three, we have got 1,750,000. and then we add our 450,000, and then also we add our 800,000. So these are the three that we have. So the total that you are supposed to get there is 3 million. 3 million. And this is the total of non-current assets. So this total also is supposed to come here to represent that these are the non-current assets that we have. We might have some financial non-current assets that we can put there, like fixed deposit, but in this question we don't have such. So we are just going to put this figure here to represent that this total for non-current assets there. So if they were fixed deposit, if they were, we had 6 fixed deposits in this question, we're supposed to add to this 3 million to get the total that we put here. But here we're just going to put our 3 million here. So this is what we have on non-current assets. And remember, the first part we said we are going to add non-current assets and current assets. So now we are on current assets. So the difference that we have on current assets and non-current assets is that current assets now are the resources of a business that are going to be in that business for a period of less than a year. For example, cash, we don't expect cash to be in the business for more than a year. Even bank balances, they will be used. We have got also debtors or trade receivables. They are also part of those current assets. Even stock, as in in the form of inventory, we can also regard it as a current asset. So those are the items that we're going to pick there in the list of balances that we have there. So if you go, start from the top there, we have got here work in process and finished finished goods of inventory. So what we are having there, both of them there, they are describing our stock or inventory. They are our inventory. Here it's inventory. The only difference there that is there is that work in process is those goods that are still in the process of being produced. Remember, at a manufacturing company, goods are being produced. They are those goods that are finished. They are still being produced. That is work in process. So those are also stored, and they form part of our stock. And then finished goods now represent those that are finished in the production process. So we just add the two to get the total for inventory. I don't put them separately again. Just put as a total 40,000 plus 46,000 as inventory. So we go there and just summarize that. We have got inventory. So on inventory, we are saying we are adding 40,000 plus 46,000. So we add the two, we are supposed to get 86,000. So we have 86,000. 86,000. So the total for assets, we're going to put it here. So we're just listing the current assets that we have there. Then the total will put it in line with description that we have for current assets that we have there. So are we going to pick another current asset that we have in the business? We go down. This is a current liability, trade and other payables. We skip it. We've got petty cash. This forms cash and cash equivalents. Cash and cash equivalents describes cash, all resources that we have that are in the form of cash. We call them cash and cash equivalents. We might have petty cash, even cash on its own, and then we might also have the bank balances. Money the bank also describes cash and cash equivalents. So if you look at it there, we have got bank here, and we have got petty cash here. So we are going to add the two. We just add the two for petty cash. We have got 8,000, and then for bank we have got 89,000. So we are going to add the two, and they are described as cash and cash equivalents. So when we come here now, we are saying cash and cash equivalents. Cash and cash equivalents. So on the calculation part here, there we are saying 89,000 plus our 8,000. I will add the two there, we are going to get 97,000. So this is what we have. And then I will try to see again if we have got another current assets that we have there in our list of balances. Right, in between there, we've got SARS 41,000. Like this one, SARS, it can be a current asset, it can be current liability, but when you're given it like this, in most questions, they give you all the debit sides. They put the debit sides on the a trial balance, and then they put a credit side. When it's on the credit side, we say it's a current liability. When it's on the debit side, we say it's a current asset. But in this sense, we are just given it as put 1,000, so we just assume it's a current liability. So this is what we have. So we can skip that one and go to trade and other receivables. These are the debtors. So these are the people, customers, or businesses that we are selling goods to on credit. So they become our debtors. They owe us money. So we are saying they are debtors, but we expect them to pay that money within a period of less than a year. So that's why we are putting them or classifying them under current assets. So we have got trade and other receivables. We have 163,000 also as a current asset. So we can describe that one. Trade and other receivables. We can call them debtors, as just means the same thing. 163,000. And then we go back again to check if we have got any other current asset that we have in that list. We are seeing now we have got vehicles. These are the not current assets. We go down to check. You see now we've got long-term loan. This is a non-current liability. This one is a non-current liability. And we've got capital. It's going to form. It's part of our equity. It's not a current asset. So this is what we have. So it means we have exhausted all the current assets that we have. We can just go there to add so that we find the total 86,000 plus 97,000 plus 163,000. So let's try to add. Let's use our calculators there and try to find out what is the correct total there. But according to my calculations, the total that we have there is 346,000. So here we have got 346,000. So the total will come on the last column. So this is what we have for current assets. So what does it mean now? We now have the total for current non-current assets and current assets. So we are going to add the two to get the total for assets. Remember that accounting equation that we have to find the figure for total assets. So the total will come here is our total assets. So if you add the 3 million plus 3 million, sorry, it's 3 million plus 346,000, we get 3,346,000. So here we have 3,346,000. So this is our first balancing figure, and it is total assets. So you can see that we've added current and non-current assets. So this is what we have. So this forms the first balancing figure. So we are this figure is not going to affect any calculation that is going to come below, because it's going to represent the first balancing figure that we have there. So beneath now, we are going to the second part of that accounting equation. Remember, we said assets is equal to equity plus liabilities. So we are now going to the section of equity and liabilities. So we can have a heading here, equity and liabilities. So we are going to list all the equity and liabilities that we have. Remember, equity, I said this is also capital. So we start with capital. And we try to see what the figure for capital that we have there. Right, for capital, we have got this figure, which is 2,727,000. This is the figure that we are given. But if you see in the list that we are given there, we also have some adjustments, some figures that are going to adjust this figure that we have 2,727,000. We have got drawings. They reduce the balance of capital. We have got, if you go up there, you'll see that there is our net profit there. It increases our level of capital. So the formula that we employ there, is you'll be trying to find the figure for closing capital. So you say it is equal to opening capital balance. This opening capital balance, the balance that you're given in the list there. Then you add your net profit. If there's a net loss, you subtract here, add net profit, or you subtract a net loss, depending on the figure for profit that you are given. If it's a negative figure, it means you are supposed to subtract. Then if there's additional capital that has been introduced during the year, you add it here, additional capital, and then you subtract your drawings. This is how we calculate it, but it depends with the question. Some figures will not be there. Like in this question, we don't have additional capital. We don't have our net loss. We only have net profit. So what I'm going to do is going to say opening capital, we add net profit, then we subtract our drawings. So this is what we have. So according to our question, let's try to see those figures. We are seeing that our opening capital that we have there is 2,727,000. And then we're going to add our net profit 543,000. We subtract our drawings 65,000. Then we get our figure for capital. So we come here now, we just conclude that what we are going to do now in brackets, you can just show the calculation on how we arrived there on capital. Let's check the figures that we have. We are saying for capital, opening capital is 2,727,000. 2,727,000. We add our net profit. Let's check the figure. Net profit to 543,000. 543,000. Subtract the figure for drawings. Drawings there is just below. Drawings is here 65,000. So subtract it. So drawings represents those resources that are taken by the owner for personal use. We say as drawings, the owner maybe takes cash to pay for family business, for his or her kids, etc. We say they are drawings. So they are going to reduce the figure for capital. So this is what we have. So if you calculate this figure, you see that the figure that we are going to get is 3,205,000. So this is what we have there. So on that one, we can this is the figure that we are having for our capital. For capital, 3,205,000 there. Then we put it there. We can put it in front there to represent that this is our equity. So we are supposed to put a heading here of equity, and then we put it here as 3,205,000. So this is going in line with this one. This description of this figure is equity. So and then we have capital, or the part of equity is capital that we are having here, and it's here. So now we go beneath that now to list our liabilities that we have in the question. We are saying now our liabilities. We start with non-current liabilities. So basically, the word liability means what we owe as a business to other parties outside, e.g., loans that we take from financial institutions, part of liabilities. Even when we buy goods on credit from suppliers, it's part of liabilities because we owe them money. But we classify them now into non-current and current. Non-current, we are saying we are going to repay these owings that we have for a period of more than a year. Maybe you're going to repay a loan for a period of more than a year, we classify it as a non-current liability. When you pay a loan, maybe for a period of less than a year, that's a short-term loan, so we call it a current liability. So these are the differentiations that we have there in terms of non-current liabilities and current liabilities. So we can go there and check what we have in terms of non-current liabilities. We've got a long-term loan. This is a non-current liability, 90,000. So we can just go and include that one. And this is the only non-current liability that we have in the question. If we had some mortgages, also we are supposed to include them there. So long-term loan, the figure that we have there is 90,000. And then this is now going to represent the total for non-current liability, and it comes in line with the description of non-current liability. We have got 90,000. If we had another non-current liability, we should have we could have a listed it below here, and then we add the two to get the total, we put it here. So this is what we have now. And now we proceed to current liabilities. Current liabilities. So on current liabilities, we're going to check what we have there in terms of current liabilities. Remember, I said we repay them for a period of less than a year. I'll start from the beginning there. We go down to check there. We have got trade and other payables. These are creditors. What we are saying here, we are saying we bought goods on credit from suppliers, and we are going to repay them on average is less than a year. Usually credit terms for suppliers are 30 days. We are supposed to pay them within 30 days usually. That's the average credit term that is there. So it's a current liability, trade and other payables. Trade and other payables. So on trade and other payables, we have the amount that we have there. It's 10,000. So we're going to check again. What else do we have? So we've got that figure that we classified as a current liability. If you still remember for SARS, this is tax that we owe to SARS, South African Revenue Services. So we owe 41,000. So we need to pay that. So we are saying it's a current liability in the sense that we expect to pay that amount within a period of less than a year. So we say 41,000. We can just say SARS. There's a description there, SARS, and we are having 41,000. So these are only the current liabilities that we have in the question. And then we add the two to get the total for current liabilities and put the total here, 10,000 plus 41,000, you get 51,000. So this is what we have in terms of current liabilities. Now, we want now to put the total for total equity. Total equity and liabilities. So on this figure now, what we are doing now on total equity and liabilities, we are adding equity and plus all liabilities. So we are going to say 3,205,000. We are here. 3,205,000. We add our 90,000. We add our 51,000. Well, this represents equity. This represents non-current liability. This represents current liability. Then we get our total. So the total that we get here is 3,346,000. So this is our second balancing figure. Remember that accounting equation, total assets is equals to the total of equity plus liabilities. So that's this is the total for equity. So it means this is the total for equity and liabilities. And then we go there to check the total for assets that we got there. Is the same figure, you see, 3,346,000. So our balance sheet is balanced. It means we did not make any mistake in the preparation of that balance sheet. So this is what we have in terms of this balance sheet or statement of financial position. Let's stay tuned for more videos to come. Those who haven't subscribed, please subscribe and share. We are still coming. Let's stay notified as new videos are going to come. As for this video, I'm signing out.